Welcome to the deep dive. Today, we're really digging into something interesting, a recent SEC filing from Etoro USA LLC.
Yeah, this document gives us a pretty detailed look under the hood, doesn't it? Their operations, financials, future plans, especially as they might be gearing up for an IPO.
Exactly. Think of it as the inside scoop. And our mission today is simple. Pull out the key insights, the stuff you really need to know, without drowning you in regulatory jargon.
Right. We want to understand their business model, performance, the opportunities, and importantly, the risks.
So eToro, many of you probably know them, global platform, lots of different assets you can trade.
Stocks, commodities, currencies, crypto assets, the works.
And they're big.
Yeah.
Operating in, what, 75 countries?
Yep, 75 countries and about 3.5 million funded accounts as of the end of last year, 2024.
Okay, so let's start unpacking this filing. What are some of the first sort of fundamental things it tells us about how eToro is structured?
Well, right off the bat, it lays out some key legal points, like their agent for service in the U.S. is Yoni Ashia, based in Hoboken, New Jersey. And they list their lawyers, big names, like Skadden in New York, Maitar in Israel. That signals, they're serious about this potential public move and their international setup.
Definitely putting down roots in the U.S. What else structurally? The shares, maybe?
Yes, the share structure. It looks pretty typical for, tech companies where founders want to keep control.
Oh, so.
They'll have Class A common shares, 1 vote per share, likely what the public gets. But then there are Class B shares,
Okay.
10 votes per share for those, mostly held by insiders, founders, early investors, and they can be converted to Class A later.
So the insiders keep a tight grip on the voting power.
That's what the filing suggests, yeah. It says Class B will represent a significant majority of the voting power post-offering. Directors, execs, major shareholders holding a big chunk.
So even with public investors, the original team still calls most of the shots.
Pretty much.
What are the sort of pros and cons of that for a regular investor buying Class A shares?
That's a really key question. I mean, on one side, founder control can mean stability, a consistent long-term vision. They're obviously deeply invested.
Go with it.
But the flip side is less influence for public shareholders. If you disagree with a decision, well, your single vote per share doesn't carry as much weight against their 10 votes. It's a trade-off.
Makes sense. Stability versus accountability, maybe. Now, the filing defines some terms too, right? Crypto asset, DeFi.
Yeah, which is helpful. They define crypto asset as, a digital value representation using distributed ledgers, not backed by a central bank. Standard stuff.
And DeFi.
Decentralized finance. Basically, peer-to-peer financial services using smart contracts. Good to have those baseline definitions clear.
Definitely. So moving on to how they actually get users and keep them, what's their strategy there? They mention a flywheel.
Yeah, they talk about this flywheel concept. It seems to be driven by 3 things: their product range, the educational content they push out, and the platform's collaborative side.
Okay, break that down a bit. How does it work?
Well, they attract newer investors with educational stuff guides, tutorials, and features like copy trading.
Copy trading. That's where you can just mimic what successful traders do.
Exactly. It lowers the barrier to entry. You can sort of learn by doing, or at least by watching others do it successfully. It's like training wheels for investing.
Interesting. Almost like a built-in mentorship.
Yeah.
What about the experienced folks? What keeps them around?
For them, it's more about the advanced tools, the analytics. Plus, they have this popular investor program.
What's that?
It rewards experienced traders who share their strategies and engage with the community. So it encourages that knowledge sharing and builds a kind of network effect. Beginners learn, experts get rewarded, it keeps people engaged. The social aspect seems really central.
Well, it's not just a trading terminal, it's a community. And they offer more than just stocks, right? The multi-asset thing.
Absolutely core to their offering. Being in 75 countries lets them offer this huge variety: stocks, ETFs, crypto, commodities, currencies.
And how you trade them can vary.
Right. Depending on the asset and your location, you might be trading the actual underlying asset or a derivative like a CFD, a contract based on the asset's price movement.
Okay.
They also mention eToro, money for deposits, withdrawals, trading local stocks and local currencies, and things like charting tools, extended trading hours. They're aiming to be comprehensive.
Trying to be that one-stop shop. And it all ties back to the founder's vision, Yoni and Ronan Asiya, wanting simpler, transparent investing.
Yeah, and the filing notes the management team has been around a while, average tenure of 12 years, suggests stability at the top.
Okay, solid overview. Let's get into the numbers. The financial performance between 2023 and 2024 looks pretty dramatic.
Yeah, dramatic is a good word. The growth is really something. Net contribution, that's like revenue minus direct, costs up 41%.
Bro.
$557 million in 23 to $787 million in 24.
Okay.
Total commission, the fees from trades up 46%. That hit $931 million last year.
Wow. And net income, that number looked
It
wild.
really did. A
That,
161% increase from
yeah,
$15 million profit in 2023 to $192 million in 2024.
it's an incredible jump. What about adjusted EBITDA?
Also, very strong growth, up 159% to $304 million in 2024.
So across the board, really significant growth in that last year. What about total revenue over the last few years?
The filing shows that too. Total revenue and income was $12.64 billion in 2024. That's a big jump from $3.89 billion in 2023 and $6.33 billion in 2022.
So a bit of a dip in 23 revenue compared to 22, but then a massive surge in 24.
Exactly. Shows how variable things can be, but 24 was clearly a banner year.
Okay, now where's the money going? What are the big cost areas?
Well, the biggest line item by far in 2024 was cost of revenue from crypto assets, over $11.8 billion.
Billion, with a B.
Billion with a B, yeah. It was also large in previous years, $3.3 billion in 23, $5.7 billion in 22. This likely covers the direct costs of facilitating crypto trades, exchange fees, hedging, that sort of thing.
That's huge. What else?
Other notable costs in 24, margin interest expense around $37 million, R&D was $131 million, selling and marketing $178 million, and then general admin operating costs at $228 million.
Interesting how those costs shifted. Marketing spend dipped in 23, then came back up.
Yeah, might reflect changes in how aggressively they were chasing new users or market conditions.
And they talk about adjusted EBITDA specifically. Why focus on that non-standard metric?
Right, it's a non-IFRS metric. Companies use these to try and show, what they see as their core operational performance. Adjusted EBITDA strips out things like interest, taxes, depreciation, amortization, share-based compensation.
So it's meant to show the underlying profitability of the day-to-day business.
Kind of. It's a way to look at the cash-generating ability of the operations. Investors often look at it, but you always have to remember what's being excluded.
Good point. What about the performance of specific asset classes? Stocks, commodities, currencies.
They saw an 8% increase in net trading income from those areas between 23 and 24. They chalked that up to more retail trading activity.
Yeah.
And they also saw a big jump in net interest income from users. That's largely thanks to the rising interest rate environment, making more on user cash balances and margin lending.
So benefiting from both higher trading and higher interest rates.
Right.
It's a strong recent performance. What about the future? What opportunities are they eyeing?
A big one they highlight is the generational wealth transfer. Baby boomers passing wealth to younger generations.
Right, I've seen reports on that. Huge numbers involved.
Exactly. They cite a UBS report estimating $83.5 trillion transferring over the next couple of decades. Etoro thinks a lot of that will go into investments, creating a wave of new, younger investors.
A massive potential market shift. What else?
They're also leaning into changing consumer expectations. People want digital, instant, intuitive, personalized experiences. They think AI will accelerate this.
How so?
Well, platforms like theirs have tons of retail investor data. They believe they can use AI to tailor experiences, offer better insights, and meet that demand for personalization, giving them an edge.
Makes sense. Cater to the digital native. So how do they plan to actually capture this growth? What are the strategies?
It's multi-pronged. First, acquire more users both in existing markets and by expanding geographically. Second, increase their share of wallet. Get existing users to put more of their money onto the eToro platform.
Keep them sticky.
Right. And third, grow with their users. As users get more experienced, wealthier, eToro wants to keep serving their evolving needs. They also mention potential future acquisitions to maybe speed up product development or market entry.
So organic growth plus maybe some M&A down the line, all aiming for that simple, transparent global access.
And they stress that their diversified platform helps them weather different market conditions. They're not just a crypto platform, for instance, even though crypto commissions have been significant but also volatile.
Right, diversification is a buffer.
Mm.
Okay, sounds promising, but let's talk risks. Every SEC filing has a long list. What are the big ones for Etor?
Oh yeah, it's a comprehensive list. Market volatility is a huge one. Their revenue depends heavily on trading activity, which swings with the market's stocks, crypto, currencies, commodities. Political turmoil, economic shifts, it all impacts them.
The nature of the beast in finance. What about competition?
Fierce. They admit it. You've got the big traditional brokers, but also newer, sometimes less regulated fintechs all fighting for the same customers, and they expect it to get even tougher.
That regulatory difference is interesting. Some competitors might move faster if they have fewer rules.
Potentially, yeah. It's not always a level playing field. Another risk they flag is just sustaining that rapid growth. Can they keep it up? Or will things slow down due to market saturation, competition, new regulations?
And interest rates.
Yeah.
We saw they benefited from rising rates.
But falling rates could hurt their interest income, so they're exposed there too.
And the regulatory environment itself must be a minefield.
Absolutely massive, complex, constantly changing, different rules in 75 countries. Compliance is a huge ongoing cost and effort. They mention things like UK consumer rights laws, anti-fraud, anti-money laundering, counter-terrorist financing. Failure here is not an option, but hard work.
Sounds like a full-time job just keeping up with the rules.
Sure.
Other operational risks.
Liquidity and capital. They need enough cash on hand and need to meet regulatory capital requirements. Not doing so could restrict growth, hurt user trust. They also note, just because the market potential is huge doesn't mean they'll capture it.
Right. Opportunity isn't guaranteed revenue.
Exactly. Plus, consumer protection laws impacting their user agreements. Geopolitical risks, too, sanctions affecting Russia, the situation in Israel where they're based.
And specific risks around their features, like copy trader.
Yeah, social trading has its own risks.
Mm.
Operational hiccups, different regulations in different places, treating it differently, and reputational risk if the traders people copy lose money.
So the social aspect cuts both ways. What about social media outside their platform?
Risks there, too. Misleading statements by users online, potential liability for third-party info, challenges moderating content under rules like Europe's Digital Services Act, and of course, the general risk of lawsuits and regulatory enforcement actions.
It's a complex web. We haven't even talked tech risks yet.
Crucial ones. Cybersecurity is paramount. Breaches could be catastrophic financially and reputationally. System reliability: can the platform handle huge trading volumes without crashing?
Always a concern with online brokers.
And even risks with AI, using licensed AI that might infringe on IP, generate biased results. Risks from using open source software too.
Wow. What about people risks?
Talent. Big concern. Attracting and keeping skilled people, especially in a hot market like Israel. They even mention return-to-office policies potentially affecting morale. Maintaining company culture is key, and potential conflicts of interest among insiders.
The Israel situation, again, operationally.
Yes. The political and military situation there is explicitly listed as a risk, cyber attacks related to that too. Then there are tax risks, changing international rules like the OECD's Pillar 2 minimum tax. Israel plans to implement parts of that in 2026, which could impact their effective tax rate.
Okay, one last one here. Share ownership restrictions.
Yeah, some regulators require approvals if someone wants to buy more than, say, 9.99% of the company. Their corporate documents have provisions to deal with that. It's a lot of potential headwinds.
It really is.
Yeah.
A company growing fast, but definitely juggling a lot of risks. Okay, let's shift to governance and the share structure. We mentioned the dual class setup. Anything else important there?
Well, they state pretty clearly they don't plan to pay dividends anytime soon. They intend to reinvest earnings back into the business.
Standard for a growth company going public.
Pretty much. Future dividends are up to the board. They also mention a chunk of Class A shares are reserved for employee stock plans. And the IPO price in the filing is just an assumption for now, the midpoint of the expected range.
What about trading the shares after the IPO? Any restrictions?
The shares sold in the IPO will generally be freely tradable, but insiders, execs, directors will likely be under lockup agreements.
Meaning they can't sell their shares for a while.
Usually for 180 days after the IPO, yeah. Standard practice to prevent immediate selling pressure. They also warn that future stock or debt offerings could dilute existing shareholders.
And they acknowledge their management team doesn't have deep experience running a public company.
Right, that's listed as a risk factor. And because they're a foreign private issuer, they might follow Israeli governance practices instead of all the NASDAQ rules, which could mean slightly different shareholder protections compared to a U.S. company.
Good to know. Finally, let's touch on the financials and audit details. What's covered there?
They go into their accounting policies, how they recognize revenue, especially for crypto, how they account for crypto held for users. More detail on expenses, interest, those non-IFRS measures like adjusted EBITDA.
Okay.
They also discuss managing financial risks like currency and interest rate fluctuations, capital requirements for their regulated arms, their debt facilities like a current credit line with Bank Hapolimim, tax details like deferred taxes. Importantly, the auditor's report.
Anything stand out in the audit report?
They mention a critical audit matter related to the existence and valuation of crypto assets, basically highlighting that auditing digital assets is complex and a key area of focus for the auditors.
Makes sense, given how central crypto is and how new it still is from an accounting and auditing perspective.
Uh-huh.
Okay, we've covered a ton of ground. Let's try to synthesize this. What are the main takeaways from this deep dive into eToro's filing?
I think it paints a picture of a company that's really scaled up, become a major global player, and seen impressive financial growth lately. That growth seems fueled by broader retail investor interest and their multi-asset strategy.
Like,
But they're operating in a really tough environment. High volatility, intense competition, a constantly shifting regulatory landscape across dozens of countries, and significant technological risks. It's a high-growth story, but one with substantial hurdles.
a really good summary. Potential and challenges in equal measure. So here's a final thought for you, our listener, to chew on. We talked about that dual-class share structure, the significant voting control held by founders and insiders. How do you think that concentrated power might play out long-term?
Yeah, how does it affect strategic decisions, shareholder influence, especially as they face all these complexities in the public markets? Is it a recipe for focused innovation, or does it create potential conflicts and reduce accountability?
Something to definitely consider. What's that balance between strong founder leadership and broader shareholder interest?
It's a fundamental question for investors in companies with these structures. And if you want even more detail, the full SEC filing is out there. It's dense, but it's all in there.
Absolutely. Hopefully this deep dive gave you a clearer view of eToro, the business, the numbers, the opportunities, and the risks. It's certainly a fascinating player in the evolving world of online investing. Thanks for joining us on the deep dive.